Hi there, I'm Rose Jacobs and it's great to be with you again for kalkinemedia. Today we're going to look at the pros and cons of flash loans on DeFi. But before we get started, of course, press that bell icon at the bottom of your screen for all the latest updates. Now, flash loans use DeFi technology to allow the borrower access to cryptos without any collateral. Flash loans are recorded on smart contracts and the transaction is reversed if the borrower fails to repay. Flash loan attacks are an issue and it has become a tool for manipulators to earn quick profits. Cryptocurrency trading is not limited to purchasing an asset and selling it at an appreciated price. Over the past few years, cryptos have evolved with many features that resemble traditional finance. One such offering is flash loans. So, how does a flash loan in cryptos differ from other credit products? Let's find out. Flash loans are essentially a feature within decentralized finance. Ethereum is the leading DeFi enabler. On decentralized exchanges, cryptocurrency holders can stake their holding. This is called yield farming, earning revenue by lending, not selling. The loan borrower pays an interest in cryptos, which is the underlying revenue model. Aave and DYDX are popular Ethereum-based DeFi protocols. Flash loans are instant. Instant loans have also made it to the traditional financial landscape. These pre-approved loans are given out without any hassles like extensive paperwork or background checks. Flash loans in cryptos have similar underpinnings. A borrower can take out the loan in the desired crypto asset in no time. The transaction is recorded on the blockchain's smart contract. Flash loans require no collateral. The key feature of flash loans is that they do not require any borrower's security. This reduces the entry barriers for new crypto enthusiasts. They can request cryptos from a lender without demonstrating the capacity to repay. Flash loans are secure, at least in theory. Flash loans on DeFi protocols are secured by smart contracts. The entire transaction of lending and repaying is recorded in a single smart contract. The contract promotes self-adherence of the terms, and in the event of breach of promise by any party, the entire transaction is reversed. This means that the lender is given the cryptos back in case of failure on the borrower's part. Flash loan attacks. Well, a BSC-based protocol, Pancake Bunny, was attacked by crypto scammers who manipulated flash loans. By taking out hefty flash loans, any borrower can manipulate the crypto asset price in the wider market. The biggest issue is that the entire transaction is still fulfilled as the manipulator repays the loan by keeping the illicit profit made on the deal. So are flash loans on DeFi in the future? Instant loans in cryptos sound like a promising aspect, and by steering clear of collaterals, the entire story sounds more appealing. However, flash loan attacks shine the spotlight on the vulnerabilities. The worst part is that anyone can pull off an attack with ease. If DeFi protocols can figure a way out, flash loans may become a promising arbitrage tool in the hands of crypto investors. But that's it for today's report. If you like what you've heard, then do be sure to like, comment, share and subscribe, and check out kalkinemedia.com. I'm Rose Jacobs. Thanks again for joining me.